Okay, everyone, we're going to tackle a comprehensive problem from Chapter 1. And what it does is illustrates the equity method that was presented in your text. And remember, the equity method is something that you apply when you own between 20 and 50% of another company. We'll call that other company the investee. Now, if you own less than 20%, then it's a very simple, straightforward way to account for it. And the book talks about the way you will hold that investment as either a trading security or an available sale for security. And it's not really problematic to handle the accounting, and it's something that you learned about back in your intermediate accounting class. And so now we get into the equity method and what that does to us. And in this problem, it's actually we're going to buy some additional shares that throw that percentage into that range between 20 and 50% when we have to apply the equity method. And we'll also illustrate how you have to go back and retroactively show that when you're presenting comparative financial statements. And it will have some fun doing that. So let's read through this problem. Before we get started, though, I want you to print out, make sure you have a blank template of this problem so you can kind of make some notes to yourself as we go through and follow along with these calculations. So let me start the drawing process here, and let's read through the problem together. On January 1st of 2012, Big Company pays $70,000 for a 10% interest in Little Company. On that date, Little has a book value of $600,000, although equipment with a 5-year life is undervalued by $100,000 on its books. Little Company stock is closely held by a few investors and is traded only infrequently. Because fair values are not readily available on a continuing basis, the investment account is appropriately maintained at cost. And this is the investment account that Big has on its books of Little. So we have to just have to carry it at cost because it's not traded on NASDAQ, so we don't have that readily available information that we would mark to market this security. Okay? Now, going on in time, January 1st, 2013, Big acquires an additional 30% of interest in Little Company for $264,000. This second purchase provides Big the ability to exert significant influence over Little, and Big will now apply the equity method. At the time of this transaction, Little Company's equipment with a 4-year life was undervalued by $80,000. And then they give you the income and dividend data for 2012 and 2013. And then they also say that the cash dividends are consistently paid on July 1st, and any goodwill is considered to have an indefinite life. And that's typical of almost every transaction. Is goodwill is not amortized over any finite life. Now, the first question: what income did Big originally report for 2012 in connection with this investment? That's a fairly straightforward question because we see that there were dividends of $110,000 that were paid, and Big had a 10% interest, so you simply get $11,000. And then what does Big do on its books? Well, the journal entry they make for that debit and the credit, where they're going to debit cash for the $11,000 and then credit dividend income for the same amount. Okay. Now, on comparative financial statements for 2012 and 13, what figures should Big report in connection with this investment? Now, the reason they're asking this is because you're going to have to retroactively apply the equity method. This right here is not the equity method. This is just where you have an investment at cost. You're not marking it to value. I think they told us earlier that there's not a readily available market for this stock, but you'll carry it at your cost, and then as you get any income, dividend income, you debit the cash and credit dividend income. But now, if we flip to this equity method, we've got to now retroactively apply that for 2012 as if we were accounting for it under an equity method. Now, before we move on with all the calculations, there's an additional wrinkle here. In 2014, they're going to tell us that Little has $400,000 in income from continuing operations. They also have a $60,000 extraordinary gain. They pay $120,000 in cash dividends, and there is what we call a downstream sale. Big is selling inventory that cost $80,000 to little for 100,000. Now notice we've got a 20% margin here, right? 100,000 is a selling price, but it only costs them 80,000. It's a downstream sale because the investor, big company, is selling stuff to a company. I'm not going to call it its subsidiary because it is not consolidated. It's somewhere between that 20 and 50% ownership. So we'll call it the investee. So big is selling inventory to its investee. It's a downstream sale, and they're saying that 30% of that inventory is still sitting there on Little's balance sheet at the end of the year. And then they're saying that they've maintained the same 40% ownership throughout the period. Okay, now, so what are the journal entries that they make? This is for the second part here, part B. They're saying what entries would you make for 2014? So there's a lot ahead of us here, but let's just talk about what we've got to do in 2012 and 2013. Before we get there, though, I want to go back and I want to look at this book value of the company. See, the book value started out with $600,000 in that first year. And what I'd like to do is a simple roll forward of that book value of the company. So in 2012, January 1st of 2012, and it looks like my pen is really wanting to act up on me here. Let's get down into this area here. Let's see if we can do. So the first of the year, I won't write the years. I'll just put, we have $600,000. I don't know why this is wanting to do this way. Let's do it over here. There, it likes that better. So we started out with $600,000 and we had income, $210,000. You see where I'm getting that number right here. Okay, and remember that net income serves to increase the book value of the company. It's close to retained earnings. But then they also paid dividends of $110,000 that year. So now my book value is at $700,000. Remember, that's net book, call it NBV, net book value at the end of 2012, and this was the beginning of 2012. Okay, 1/1 of 2012, and this is essentially 1/1 of 2013, right? Because what was the net book value at December 31st on New Year's Eve, when the clock flips over to 12:01 on January 1st, it's the same number. So that's how I do a roll forward of the book value. So we're going to need that number in just a minute here. So now what we're going to do for the 2012 year is we're going to now retroactively make it look like we accounted for this under the equity method. So what did we pay for that 10% share? Remember, go back to your problem and you can see from the previous page it was $70,000, right? Now, and we acquired 10% of the company times the book value of $600,000. So what we got for ourselves, for our $70,000, we got $60,000 of book value. And so we paid in excess of book value, $10,000. Now, we have to look at the assets that we bought, and if you go back to the problem, it says that all of that is assigned to equipment. Okay, and that's nice, a nice thing, because every penny of that now is assigned equipment, which means what? It means that we have no goodwill to recognize. Goodwill is actually zero, right? Because all of this excess is assigned to equipment. And we're going to see in just a minute, if you can't identify the specific assets, that excess amount that you paid, if there are no specific assets to assign it to, then by definition you have created or purchased actually some goodwill. So in this case we don't have any goodwill. The other thing I'm going to do for myself is, remember it said that they have a 5-year life on that equipment. Okay, so I'm going to just note right over here in the margin that I'm going to have to eventually take care of this $2,000 amortization. We're not going to do it yet, but eventually we're going to handle that. Okay. Now in 2013, you paid $264,000 and you got a 30% stake in the book value of the company. Now, the $700,000 is from that roll forward that we just did, okay? Because at the time they made this purchase, the book value was $700,000. And so then what we purchased, book value, was 210. The 30% times the net book value of their balance sheet is 700,000. Okay, so what's my excess? Simple arithmetic is $54,000. And they did tell me that the equipment at that time was undervalued. In other words, what the net book value of the equipment, the original cost, historical cost, minus accumulated depreciation was $80,000. And I bought a 30% stake in it, so therefore I've got a $24,000 undervalue on equipment. So what I'm doing now is I'm going to take of this 54,000, I'm going to assign 24,000 to equipment. Now the excess, because I don't have anything else to assign this excess amount that I paid, is going to have to go to goodwill. Okay? So when I bought that additional stake, I now have goodwill on my books. Now, I'm also going to do this side calculation on this 24,000 that's assigned to equipment. And remember that it said that there's a remaining life of 4 years. So then I'll have to deal with $6,000 a year per year amortization. We're not going to mess with it yet, but let's keep that in mind. Now, with all those calculations, and hopefully you keep those in front of you, what am I going to now have in my financial reporting that I have to do on my books? Well, in 2012, Little had $210,000 of income. Remember that from your previous table in the start of the problem. Big had 10% ownership, so therefore they need to recognize $21,000 of an accrual that we'll call. Now, here's my amortization that I did previously, that $2,000. Remember the equipment over a 5-year life, it was undervalued by $10,000, and on the 5-year life is going to give me $2,000 a year. So now I have, on an equity method, $19,000 that I'm going to recognize. Okay. So, what do I have on my balance sheet? What is on Big's balance sheet in 2012? I paid $70,000 for that ownership stake. I have $19,000 that I need to recognize. Okay, this is where that came from. The $19,000 is my share of Little's income. Little made $210,000, so I'm entitled to recognize 10% of that, but I have to amortize that equipment. Remember the $2,000. So that's how I got my 19. So I started with a cost of 70. I'm going to increase that by $19,000, but they paid me a dividend. Now, in the equity method, the dividend, remember, it serves to reduce my investment account, the investment that I'm going to show on my balance sheet. I'm big company, so I'm going to show this investment in Little, but if they pay me a dividend, it serves to reduce that. So I got to take my share. They paid $110,000 in dividends, and I own 10% of them. So that $11,000, instead of this real simple entry, debiting cash, crediting dividend income, not under the equity method, what I've got to do is reduce my investment account. And so now you get down to the end of the year, and my investment account is $78,000. Okay? 2013, what are we doing? Okay? Little had income of $250,000. Now, remember what happened is I increased my ownership percentage by 30%. So now during 2013, I own 40% of that company. The company earned $250,000. So my share of that is $100,000. Okay. Now, here's that equipment again. I knew we were going to need that. There's my $2,000 from the 10% purchase. And when I made the second purchase, there's $6,000 that needs to be amortized. Okay, so remember those from previously. And now I'm down to a net equity in the investee income of 92,000. Okay, now, so what's my investment in little? This is on Big's balance sheet. What is the book value? Well, we had at the beginning of 2013, which is the end of 2012, I have the $78,000, which is from above. Okay, I spent $264,000. Pardon me, it's 264 to buy that additional 30%. My equity income in little is 92,000. Remember, that's where that came from. And they paid dividends. They paid dividends of 100,000, and so I get $40,000 of that. Now remember, that 40,000 is cash coming into my door. Okay? But what do I do with it? Instead of recognizing dividend income, I'm going to debit cash and I'm going to credit the investment in little. Hence, this is in brackets. So now the investment is valued at $394,000. Okay, at the end of the year. So how do I account for all this good stuff? Well, the 2014, we had Big receiving a $48,000 cash dividend from Little. And remember, we owned 40%. They had $120,000 of income. So that entry on my books in 2014 is debit cash for the 48,000 and credit investment in Little. Okay. Now, at the end of 2014, the annual accrual of income as well as the adjustment to record amortization is made. The investee's continuing income is reported separately from the extraordinary item. Okay. Remember that we had both income from continuing operations as well as this extraordinary gain. So what do? The investment in Little, I will debit that. For $184,000. And that is my 40% times the $400,000 of operating income. Now, the credit is an income statement account, a period account, remember. So I'm going to have this on my P&L. P&L is profit and loss, my income statement. So the credit is called equity in investee income. Okay, for the 160,000. And then I'm going to pick up the $24,000 of my share of the extraordinary gain of investee. I apologize we lost our writing there. It came back. So this extraordinary, both of these accounts are P&L accounts. They're going to show up on my income statement, on Big's income statement, but I have to bifurcate them between the extraordinary piece and the piece from continuing operations. Okay. Now, the amortization on that excess payment in relation to the equipment, remember we had the $2,000 from the first purchase and the $6,000 from the second purchase. So combined, I'm looking at $8,000. And what do I do with that? Well, remember, those entries are going to serve to reduce my investment in Little But what's my debit? My debit is against this equity and investee income. Remember, if I want to decrease a revenue or an income item, I'll have to debit that, so that's what I'm going to do here. Equity and investee income. Okay. Now what's the last thing I need to take care of? Well, remember that downstream sale. Now, the calculations I have down here for you, remember the gross profit was 20%. They sold it for $100,000. It cost big $80,000, so there's that $20,000 profit, so it's a 20%. Now, because Little, the investee, still has $30,000 of that merchandise, the profit on that is $6,000. Very simple. I'm just taking the 20% times the 30,000 to get the 6. Okay. However, Big only owns 40% of the stock of Little, and so thus my unrealized intra-entity gross profit at the end of the year is $2,400. There's my ownership percentage, and there's the $6,000 of profit on that $30,000 of remaining merchandise. So remember that you have to always contemplate what is my respective ownership percentage. So bottom line is I have $2,400 that I need to deal with. And what do I do with that? Well, again, it's going to be the same thing as in the previous illustration, is the same accounts. I'm going to debit my equity in investee income, and then credit my investment in Little. Okay, as you might guess, what I need to do as an accountant for Big is I'm going to keep a roll forward, probably a spreadsheet, okay, because I'm going to have more than one equity investee, typically. If you're a large company, you may have dozens of these things. So it's important to keep that running total and keep it in detail. Lots of notes, lots of cross-referencing, so that you understand where all these numbers came from, and you roll that balance forward from year to year. Okay? And that concludes our comprehensive problem that discusses equity method.